Let's look at Article 11, Paragraph 1 of the India-USA Treaty, which deals with the right of state of residence to tax interest. In our example, let's assume that the recipient of interest is a tax resident of USA, right? Interest arising in a contracting state, right? This contracting state has to refer to the source state. Why? Because if the interest is arising in the state of residence, then obviously it is taxable there. And the question of a treaty application may not necessarily arise. So interest arising, which means first, one should understand whether or not a payment is interest. Second is, where is the interest arising? And to see that, what provision should I apply? Should it be the provision of the Act, right? Or is the treaty, the Article 11 that I am looking at, provides where should interest be arising? But having said it, if there is an interest which is arising in the source state and paid, not only should the interest arise in the source state, which is India in our example, but it should be paid to a resident of the other contracting state, which means to a resident of the United States, may be taxed in that other state. What is the reference to the other state here? It is reference to the state of residence. So this basically, Article 11.1 gives the state of residence, in our example US, a non-exclusive right to tax such interest income. The use of the word may be indicates that the right to tax such interest is non-exclusive. It is not an exclusive right to tax the interest income, right? So what are some of the characteristics of this article? The first one is that interest should be both arising in source state and paid. If it is only arising and accruing but not paid, in that case, from a recipient's perspective, it is not liable to tax there. Now, there are certain judicial precedents in which it has been held in the context of India-Singapore Treaty that even though this amount may not be taxable in the hands of the recipient, the provision of Section 195 relating to the withholding of taxes will still apply even if the interest has not been paid. While in some cases it may effectively result in the payment of the tax liability of the non-resident, given these judicial precedents, one needs to keep that in mind. The second is the recipient of interest should be a resident of the United States, right? If he's not a resident, he's a national, then he's not covered here unless there is a provision in the treaty which gives the nationals of a contracting state the same right as a resident of that state. Third is both source state and resident state have the right to tax. Why? Because 11.1, Article 11.1 just gives a non-exclusive right to the state of a residence actually, to tax such interest income. To ascertain whether interest has arisen, one needs to look at the provision of the Act if the treaty is silent, but if the treaty gives you a provision, then you need to consider that if it is more beneficial. If the treaty provision is not beneficial, you can actually look at the provision of the Act as well. The definition of interest as per Article 11 should apply. Normally, Article 11 does define interest, which we will see as a part of this presentation subsequently, unless the provision of the IT Act are more beneficial, in which case you can take shield under those provisions to claim non-taxability or a reduced or a discounted taxability.